Hello everyone. I'm assuming if you clicked on this video, it's because you'd like to gain a deeper understanding of options. And you're in luck. This video is going to help you do exactly that. Some quick history on options trading. The first options were traded in ancient Greece to speculate on the size of that year's olive harvest. Contrary to popular belief, options trading began essentially as a betting service in America in what's called bucket shops. Bucket shops would match people with opposite views on the future of a stock's price, and they would essentially place wagers against each other. So let's get into the details. What is an option? Well, an options contract is an agreement between a buyer and a seller of that contract. One contract represents an exchange of 100 shares of stock at a certain price and expires on a certain date. As a buyer, you have the choice to exercise this agreement at any point between the day you purchase it and the expiration date of the option. As a seller, if the buyer decides that he wants to go through with this agreement, you are obligated to hold up your end of the deal. There are two main types of options: a call and a put. A call option is purchased when the buyer believes the price of the underlying asset will increase, and the put is the exact opposite. So here we have some blank statements that summarize the agreement from the buyer's perspective and the seller's perspective. The blank labeled A is the action. The buyer will either, depending on whether it's a call or a put, will buy or sell the stock, and the seller will always do the opposite. Blank B is what's known as the strike price. This is a price the two parties agree upon at which this exchange will happen. And this is regardless of the current price of the stock. The exchange will always happen at the strike price if the buyer chooses to execute his right. Next, blank C is the expiration date of this option. This is the agreed upon date at which most likely the buyer will decide whether or not they want to exercise this agreement. And lastly, blank D is the premium. This is the price that the buyer pays to acquire this contract. The seller of the contract will always get to keep this premium, regardless of whether or not the buyer executes this deal or not. The buyer of the call hopes that the price of the underlying asset increases above the strike price at expiration. That way, they can buy the stock in this exchange at a strike price below the actual rate and immediately sell it for more than they purchased it for. On the flip side, the buyer of a put option hopes that the value of the stock will fall below the strike price upon expiration. That way, they can buy the shares at the lower price and sell them at the higher price agreed upon in the contract. So why are options used? Unsurprisingly, the four main reasons people purchase and sell options are very similar to the same four reasons people purchase and sell stock. By far, the most popular use of options is for speculation. When an individual believes the price of a stock is going to move in a certain direction, they can use options to profit off of that movement. Next is hedging. People with large positions who own a lot of stock can use options to hedge those positions and minimize the risk. For example, if somebody has a lot of shares of a certain stock, they can buy put options, and that way they're protected if the price of the stock falls. The next is income. And income is usually the people who provide those options to those hedging. Thus, they try to profit by selling options. Lastly, we have growth. Buying options for growth is pretty rare and is a very niche part of the options market. The reason options would be used in any of these four strategies versus just buying the stock outright is because of a principle called leverage. Leverage is where you use a small amount of capital to control a large amount of stock. For example, when you purchase an option, you pay the premium, and the premium is much smaller than what you would actually have to pay to acquire 100 shares of that company outright. However, an increase in the stock's price reflects a similar increase in the options price. For example, if you bought an at-the-money call and the stock price increased by $5, your option would also gain $5 in value. But since you have 100 shares under control, that would actually end up being $500. Leverage is a double-edged sword. Although you can amplify your profits, you're also taking on additional risk. Consider if you purchase the same at-the-money call, but this time the price of the stock decreases. At expiration, if the stock's price is still below your strike price, you will lose all of the premium you paid. This is compared to if you had just purchased 100 shares outright, you would still have maintained most of your investment. Likewise, a stock has no expiration date. You can hold it indefinitely, and history would tell you that its price will most likely go up. Options, on the other hand, expire. Once they expire, you will never get that premium back. Now we're going to take a look at how options prices are determined. Options prices can be broken down into two components: intrinsic value and extrinsic value. Intrinsic value is the value that this option would have if it were to be exercised today. Remember that when you buy a call, you want the price to go above your strike price, and that way you can sell the stock at an instant gain. Therefore, the intrinsic value of a call option is the stock price minus the strike price. It's a minimum between this and zero because your option can never be worth less than zero. If the price of the stock is below your strike price at expiration of this call, you simply would not execute it, and thus would only lose the premium you paid for it. And the opposite is true with a put. Now, the intrinsic value is the strike price minus the price of the stock. And if this price is above the put at expiration, you would simply not execute the option, and thus it would have zero intrinsic value. Some important terminology that you may or may not have heard before is whether or not an option is in the money, at the money, or out of the money. In the money options have intrinsic value. If you were to execute them today, then you would gain money. An at the money option is where the strike price is roughly equal to the stock price. They either have little or no intrinsic value, but have a high probability of gaining some in the near future. An out of the money option has no intrinsic value, and the strike price differs from the stock price. To illustrate this, we're over here in Robinhood looking at what's called the option chain. This lists the options, different strike prices at a certain expiration date, and here are the premium you would pay to acquire these options. These options up here, since we're looking at calls, are out of the money. The current price is below the strike price, so if you were to execute this today, you would lose money. On the other side, we have in the money options. The price of the stock is above the strike price, so you would make money if you executed today. Here we have the at the money options. These have little to no intrinsic value, but could gain some in the near future. Something to note about the options prices displayed here is that these are not the actual price you would pay. Because options reflect control over 100 shares, the actual price that you pay is 100 times the price here. So you see this option is worth $1.03 per share. So to acquire this option, we would have to pay $103. Next, let's talk about extrinsic value. Extrinsic value is the additional premium you pay on top of the extrinsic value of the option. You can find it by subtracting the intrinsic value from the option price. Extrinsic value exists because a stock price can change. Even if an option is currently out of the money, because there is time before expiration, there is still a chance that it could wind up in the money. Thus, people are willing to pay an extrinsic value to hold this option. This value scales with the uncertainty of the outcome. Because the extrinsic value is based on the probability of an option expiring either worthless or in the money, as that outcome becomes clearer, there's less extrinsic value associated with the option. This is evident either when there's a large gap between the stock's price and the strike price, or when there's very little time left before this option expires. The reason that these two scenarios reflect lower extrinsic value is because it would require a very large movement in the stock in order to change the outcome of those options. Large movements of stock prices are far less likely than small ones, and so for that reason, there's less extrinsic value. Extrinsic value can be represented by an option's Greeks, which we'll talk about now. These are the 5 Greek values: delta, theta, gamma, vega, and rho. Delta represents the change in an option's price per $1 change in the price of the underlying asset. Next is theta. Theta represents the time value of this option. Theta is usually negative. As we just discussed, when you get closer to expiration, it becomes less extrinsic value. That's what theta encompasses. Gamma represents the change in the extrinsic value for a 1% change in implied volatility. Implied volatility is a measure of how likely the underlying asset is to make a large movement. Like we just talked about, the extrinsic value of an option is dependent on how likely it is to change its outcome. Thus, when implied volatility is high, meaning the stock is likely to make big movements, options that are further out of the money or further in the money are more likely to change their outcome and thus have more extrinsic value. Vega represents the change in delta for every $1 change in the asset's price. As an option becomes further in or out of the money, its delta will increase or decrease accordingly. So vega is what we use to measure that. Lastly, we have rho. Rho is not very important. It is the change in extrinsic value due to the change in interest rates. It's important to understand that the Greeks are theoretical values. The values of the Greeks are determined by the price of the option and not the other way around. The option's price and extrinsic value is determined by the market. If there's more buyers, the price will go up. And if there's more sellers, the price will go down. The Greeks are simply a way of breaking down that extrinsic value determined by the market. The biggest mistake you can make when trading options is assuming that these Greek values will tell you exactly what's going to happen to the option price. The market is what determines the price of an option, not the Greeks. Here's an example of the Greeks given in Robinhood. It's not critical that you understand the relationship of the Greeks to the option's price in order to trade options, but they are incredibly useful for minimizing your risk and finding successful strategies. So let's talk about how you can use options. If you have a normal trading strategy, you can use options and the principle of leverage to increase your gains. As discussed earlier, you can also purchase options to hedge your current positions and protect against large downward movements in the stock market. Lastly, you could use options to bet on the price movement of a given stock. This is only for the bold though, and should only be used when you understand the risks of options trading and are using money that you don't mind losing. So what's next? With a deeper understanding of options, you're now ready to look on to more advanced options trading strategies, such as spreads, selling premium, and quantitative analysis. I'll be making videos on all of these topics in the future, so stay tuned. If you found this video useful, please drop a like and let me know in the comments. Thanks for watching, everyone, and stay tuned for the next one.